Hello, I'm here at the Mortgage Business Expo in London with Alex Maddox of the Northview Group. How are you doing?
Very well, thanks.
So recently, the Bank of England have been making noises about possibly a rate rise. Mark Carney. What influence do you think this will have on fixed rate deals?
I think there's two things that Mark Carney's been talking about which will impact fixed rate deals. The first one is the removal of monetary stimulus, like the TFS, funding for lending and so on. And basically what he's doing there is forcing banks to go back into the deposit market, the savings market, to raise money and not to rely on the central bank anymore. And the central bank money was cheaper, so their cost of funding is going to go up. And then the other thing, as you say, is he's talking about interest rates going up at the same time. And what we see in the interest rate derivatives market and the interbank markets is that the long-term cost of interest rate hedging is going up day by day. And the cost has probably gone up by 20-25 basis points, like 0.25% over the last month, which ultimately, whether it's that market or the increase we've seen in savings rates, like 2 and 3 year deposit rates have gone up by a quarter of a percent as well. That's ultimately probably going to have to be pushed through to customers at some point, or taken out of profit margins of the banks and the lenders. Current accounts haven't moved yet, so perhaps for the big banks who have access to current accounts, then it'll be a little bit longer.
So what's do you think there's going to be rate rises at sort of New Street and Kensington?
Well, we've just recently put up rates at Kensington, so I think most lenders will be doing
like a lot
that
of
at
lenders.
some point.
Perhaps this is the beginning of the trend the other way.
Yeah, it's been a long time of rates very low for for an extended period. So unfortunately, sooner or later, this was going to happen.
So with this change, do you think more customers will start flocking to fixed rates, or will some, hedge their bets on variables? The bank said it's only going to raise rates slowly, so.
Yeah, so we've actually done some research on this and trying to look over a very long period and try to find out what makes customers pick floating rates versus fixed rates. Do they start doing it when people start talking about interest rate rises? Do they pick more floating, or do they pick more fixed because they want to be protected? And what we found actually was there was very little correlation between any of those factors and what they were picking. They seemed to pick the products with the lowest initial installment, and I think there's a lot of work that can be done to help the mortgage industry understand, or help customers understand, what is likely to happen with interest rates over a longer period, because over the 2-year period it may be fine, but if interest rates are then going to go up and your cost of your mortgage is going to be a lot more expensive in 2 years' time, maybe
it sounds like brokers have a role in a way to get that message out there.
Well, also to explain what might happen after the 2-year fixed or 5-year fixed, rather than just focusing on that
Is it kind of irresponsible
period
to put them on a 2-year fix right now?
No,
I mean,
it's
if we don't know what's going to happen in 2 years' time, and we've got the EU.
But if you want a discounted variable rate product, it's the same story. So none of us know what is actually going to happen with interest rates. But I think it's a key bit of the advice is to understand the customer's situation and their risk aversion or willingness to take risk on interest rates, and then suggest the appropriate product. But we're definitely seeing more people taking out 5-year fixes than 2-year fixes, and I think that's probably a sign that people are looking at those longer dated, or they want certainty for a longer period.
So what's your view on hybrid mortgages, part and part equity release?
Really
product?
Interesting area. I mean, there's been obviously a lot of talk about equity release and hybrids being the panacea solution for people with interest-only mortgages from 10 years ago. I'm not sure I'd say that, but I do think there's the new rules of mortgage lending for the last 5-6 years means it's difficult to lend a long way into retirement. For customers, the mortgage normally has to finish before the customer goes into retirement. And for those of us that are approaching 50 or have passed 50, that means you've probably got to have a 15-year mortgage, which can be quite expensive if it's on a repayment basis. And so I think there's a growing pool of customers who are around the 50 years old mark, who don't think about going to a sort of a traditional equity release advisor to get pensions advice. They're really looking for a normal mortgage and may find it difficult to get a mortgage that suits them. If the hybrid market could solve that problem, I think it would be great for those customers, and also very attractive for whoever solves that problem, because that's a very big demographic of people in late 40s, early 50s who still want to get a mortgage, and I think they're going to walk into your standard IFA or mortgage advisor looking for a mortgage rather than going into a pension advisor.
All right, I think that's a wrap.
Brilliant. Thank you very much.
Thanks very much. Cheers.
Pleasure.